Sticker shock is poised to collide with your shopping cart, especially as the holidays creep closer, and the freshest earnings reports from America's biggest retailers reveal exactly how intense that collision might be. But here's where it gets controversial. The price impact many economists predicted still isn't fully visible at the cash register. Tariffs, simply put, are taxes on imported goods. When Washington tells a foreign supplier to pay, that bill usually slides down the supply chain until it lands in front of U.S. consumers. Analysts at Yale's Budget Lab put numbers to it. The series of levies approved so far could end up costing the average household roughly $2,400 this year. Common sense suggests stores will pass those costs along almost immediately. Yet the official inflation rate sits at 2.7%. Lower than the 3% rate recorded back in January before the current administration took office. And this is the part most people miss. Pricing remains a moving target because shelves are still stocked with pre-tariff inventory that was cheaper to import. So, what clues can we gather from the latest round of corporate updates? Let's tour the 4 chains whose quarterly earnings offered the clearest window into how retailers plan to navigate tariff turbulence. Walmart, America's largest retailer, lifted its full-year sales and profit outlook, signaling confidence that budget-conscious shoppers have more gas left in the tank. Still, executives admitted costs are slowly but steadily climbing as older, non-tariffed merchandise sells out and is replaced with goods saddled by the new taxes. Chief Executive Doug McMillon warned that each passing week brings higher replacement costs. Chief Financial Officer John David Rainey even conceded margins came in thinner than expected, forcing Walmart to nibble at markup wherever it could. Early signs also show some shoppers pulling back on non-essentials, think electronics or upscale toys, suggesting price sensitivity is alive and well. Target's sales have been stuck in low gear for several quarters, and the most recent 3-month stretch did little to change that narrative. Management underscored a clear dilemma. They want to defend their reputation for everyday low prices, but the tariff tag is growing harder to ignore. Chief Commercial Officer Rick Gomez said leadership is hammering out lower costs with suppliers first, and will treat actual shelf price increases as a last resort. Still, the uncertainty was serious enough that longtime CEO Brian Cornell confirmed he'll hand the reins to 20-year company veteran and current CFO Michael Fidelki early next year, leaving his successor to execute whatever strategy proves necessary. Home Depot home improvement shoppers may soon find certain aisles a tad pricier. In May, Home Depot had all but sidestepped the tariff conversation. By August, the tone changed. Executive Vice President of Merchandising Billy Bastek acknowledged that today's tariff rates are significantly higher, prompting selective, category-specific price tweaks, especially in product lines most exposed to overseas sourcing. The company has already ended some garden center promotions, which cooled transaction counts, though big-ticket receipts over $1,000 actually rose 2.6%. One possible explanation: homeowners tackling large projects may consider the incremental tariff costs small compared with the overall bill. TJX, parent of TJ Maxx, Marshalls, HomeGoods, off-price powerhouse TJX, delivered a pleasant surprise, stronger than expected results and a raised outlook. CEO Ernie Herrmann credited TJX's unusual business model. Because TJ Maxx, Marshalls, and HomeGoods buy excess inventory from other domestic retailers, they're less exposed to direct import tariffs. If a product category looks too expensive due to a tariff, TJX can simply scale it back. Herrmann summed it up bluntly. Whereas maybe other retailers live off that category, we don't have to. That flexibility is TJX's secret weapon. Big picture takeaways. 1. The full force of tariffs is taking longer to hit store shelves because chains are still working through cheaper, pre-tariff inventory. 2. Once that cushion disappears, costs are set to rise. And even giants like Walmart and Target admit they can't swallow every penny forever. 3. Inflation at 2.7% may look tame, but that headline figure could mask brewing pressure in specific product categories. Home improvement tools here, holiday toys there. 4. Retail strategies vary widely. Walmart is cautiously testing price increases. Target is bargaining hard with suppliers. Home Depot is making surgical adjustments. And TJX is largely dodging the issue through its off-price sourcing model. Potential flashpoints for debate. Should retailers eat the tariffs as the president urged? Or do shareholders and pension funds deserve protection just as much as consumers? Is the lower-than-expected inflation rate evidence that tariff fears were overblown or merely the calm before a cost-of-living storm? Could retailers' differing approaches create an uneven playing field, rewarding models like TJX's over traditional, import-heavy chains? Your turn. Do you believe stores have a moral obligation to shield shoppers from tariff costs, or is passing them along inevitable in a free market economy? Which retailer's strategy makes the most sense to you and why? Jump into the comments and let us know, especially if you disagree. After all, the real story of tariffs isn't written in boardrooms, it's written in our receipts.